Hello, everyone, and a warm welcome to today's major markets update for Friday, December 16, 2022. Lose a battle to win the war. This is a nice saying, I think, that is going on currently in the markets. Are the bulls losing the battle so they can win the war for our next C wave to 4,300 plus? Or are they really losing the war? And if we look even further out in the super cycle 4 that we are in. But if we look then even further out, we still have a super cycle 5 to go. So it all really depends on your time frame. But for now, things are on track and progressing nicely. We are back in the saddle, and impulses are much easier to track than corrections. The only problem one has with a impulse, be it up or down, is it can extend. And that's a little bit what we're seeing right now. We always start off with our standard Fibonacci-based extensions. A third wave typically goes to the 161.8%, but it doesn't have to. Okay, it can go to 176.4, 261.8. You name it. We start off with our primary expectation that the third wave will go to 138.2, 161.8. The fourth wave back to 100 to 76.4, the fifth wave to 200 or 176.4. That's our primary expectation. And then we monitor to see if that happens or not. If it doesn't happen, we get a wave extension. We'll start looking for the next Fib extensions. So 168 becomes 1764, becomes 2, becomes 2.2, etc., etc. The market will decide where it will bottom. And then eventually we'll adjust the fourth and the fifth wave targets accordingly. That's all there is to it. And that is the true scientific evidence-based process. When the evidence changes, so a wave extends a little bit, we change accordingly. You have to. But you start off with your primary expectation. There is no other way to go about. One cannot say, well, in January you said the market would bottom at 1800 and currently it bottomed at 2200. So you're wrong. that's great. But of course, you adjust while more price action becomes available. But such idiots we don't deal with. We're dealing with as reliable and accurate as we can go. And remember, in this market, you got to bring your A++ game. All right. This is not your grandma's market anymore. We've had 2 decades of just shoot anywhere you want and it will go up, and that's over. We need true killer instinct. Bigger picture wise, remember, I still think we are completing this A wave, the B wave, and then the C wave. That is why I'm expecting a C wave based on these bigger picture anticipations. But we know the price levels to watch where we are wrong, and that is quite easy. We have simple if-then scenarios. So no reason to front run anything. And that said, so we had a slight extension here of wave 3. Which ideally should have bottomed somewhere around 38.60 and went to as low as 38.28. In that sense, I say Crimea River. It is what it is. Even this little fourth wave here, yesterday's close, was quite the disappointment. Ideally, it should have gone to about 39.40. It didn't. This is all we got. This is all the market gave us. But we can see a nice little blip here, a hourly candle that's up. We haven't had one, so I prefer to count this as 1, 2 here. This was an hourly up candle, even by the 5 or 10 points, 3, 4, 5. Looks good. Also on the other indexes, why I prefer this, the 3, the 4, and the 5. Of course, we now adjust the wave 4 in green a little bit lower because wave 3 extended a little bit more. And then wave 5 is adjusted as well. Originally, we started off with a low at around 38.60 plus or minus 20. Now we're looking at around 37.90 plus or minus 20. It is what it is, but we don't have to front run this wave 5. We know wave 5 hasn't even bottomed yet. We knew we were still in this green wave 3. Green wave 3s are meant to short to the downside, no longs necessary, not at all. So that brings me then to the daily chart. Again, the ideal B wave target zone is always somewhere around 38.2 to 61.8%, assuming that we don't get a flat correction like we just had for the red A, red B. And we're currently now in this ideal red wave C target zone, as I also showed you here on the hourly chart narrowed down even more. So we're getting close. So I think the downside risk versus the upside reward intermediate term is already starting to favor the bulls because we now start to have clear defined downside risks here. Let's say you go long at 3,800, then you could place a stop potentially at 3,700 or even 3,600, whatever you desire, and have a rally to 4,300, maybe 4,400. So you have 600 points upside versus about 100 to 200 point downside risk. Fantastic risk management. Doesn't mean you have to throw all the millions you have at it. Start off slowly, build it up, that type of stuff. Okay, you can be really aggressive, but with high risk comes high reward. But again, high risk is the first we always look at. Risk management is all we do. That said, let's have a look at what other people are seeing. We have to look at respectable Elliott waivers to see if they are seeing something entirely different, and if so, then why am I not seeing it? And do I need to change my point of view? This is from Xenia Taubina, and she posted this, I believe, 9 hours ago on Twitter. It's publicly available. It's maybe a little hard to see here, but she's expecting a low in the, I think, 38.27 to 38.90, 38.27, 38.90 region. And she mentioned here in the last sentence the support 38.27, 38.43. So pretty good because we bottomed here 38.27. Well, of course, this has been adjusted overnight. This is something she posted this morning. So it's always easier to readjust your target zones the closer you get to the target. But this is pretty good. Then a wave 4 bounce. Hopefully you can see it. And then a wave 5. I like it. Fits very well with what I'm seeing. Let's have a look at what Zachary Manes has to say about the, I believe, NASDAQ 100 futures. As well here, he was looking for a low at around 11,140, a bounce, and then for a wave 4 and a 5 to about that level. Okay, so let's have a look then at the NASDAQ 100. Where did we bottom so far? At around 11,175. So that looks pretty good, 11,140-ish. So then we should see the wave 4 and then a 5. Matches very well. Remember, the ideal green target zone for the S&P 500, or the NASDAQ 100 cash market was here in green. So really marginally below it. I mean, this is really pissing in the margins. Excuse my French. But we should now in wave 4 and then wave 5. If this is indeed a true C wave, as we are anticipating, the fourth wave might not travel as high as this target zone. Let's say we have a little bit of overshoot for the wave 3. We might get a little bit of undershoot for the wave 4. And then the wave 5. And as you can see here, the wave 5 target zone at around 11,050, ideally, matches really well with the green target zone, the red and the black target zone. Now here I've counted this entire rally since October 13th as an A, a B, and a C wave, with the C wave 1, 2, 3, 4, 5. I can also count it, looking at this orange box, as a very complex double correction. That means that the October 15th high, I believe, or 14th high, one of the two, was already black wave A. And then black wave B is becoming a double correction. So first we had a zigzag, a flat, and now an impulse lower, which means this whole black wave B becomes a flat. Right? A flat is made up of 3 waves down, in this case, 3 waves back up, in this case, and then 5 waves down, in this case as well, because we're looking to the downside. Excuse me. So we got 3 waves down, A, B, C, 3 waves back up. Actually, the wave B became a flat. So wave A was a zigzag, wave B became a flat, and the wave C is the impulse. So we have a 3, 3, 5. Massively complex. When we top, we don't know what the correction is going to be. Remember, it's on my Twitter pinned post. Corrections are the most variable price actions you can think of. Tracking impulses here to the downside are not too difficult. All we pretty much get is a little bit of an overshoot for the third wave, and we just have to adjust the price targets. But otherwise, we pretty much know very well as you've seen over the last couple of days, to expect a 3, a 4, and a 5, a larger 3, a larger 4, larger 5. That's really all there is to it. It's really child can do the dishes type of stuff. But if you then go to something so complex as this, potentially, this is something entirely different. Now, it counts here very well as ABC, but even a flat by itself is complex. There's 6 types of flat corrections. You have regular, irregular, running, expanded. So from that, you already have 6 to choose from. Then we have zigzags. Then we have triangles. Triangles, you can have an ABC. You can have a 5-wave triangle. You can have 6, 9, whatever triangle pattern it wants to do. So there's a plethora of different corrections to pick from. So once the correction starts, you don't know which is going to be. That's why last week we were looking for a simple zigzag. It morphed into a flat. That's the unfortunate nature of a correction, but that's why we have to zoom out and keep the primary expectation for this black wave B. That's the primary expectation, and then we morph, or I would say massage everything into it. So please keep that in mind. So I'm still looking here for this wave 3, a 4, and a 5. On the daily chart matches really nicely, I must admit. And we should bottom at around 11,100. So we're getting close. So once again, the downside risk versus the upside reward starts to favor upside. But of course, we do not want to see price start going below these red and orange dotted lines. That increases the risk that all we got was a bounce and we're going to 9 or 8,000 on the NASDAQ 100. Back to the S&P 500. This is work by Avi Gilbert from ElliottWaveTrader.net. By Tuesday, I believe, he figured out this was most likely a B wave, and then the C wave target zone for the B/2 wave is then between 38, what is it here, 38.70 and about 37.20. So fits very nicely. Again, this is the target zone that you're aiming for. You don't really care too much about those scribbles unless for quicker trades. And then also here a B wave back up to potentially as high as 4,600. But let's not get too greedy and start off with 4,300. Okay. And then last but not least, our dear friend Pretzel, Dow Jones, excuse me, looking also for a 5 of 3. Lower, as you can see here on the lower right-hand corner, then of course we get a 4 and a 5. So far so good. We should have bottomed for 3. We should get the 4. If we get a 4th wave, I expect it to stall out at around 33,500, plus or minus 100. That seems to be now resistance. That was support before, right? Support, 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 and then there was a little bit of a resistance and support. So that's a critical level. And from there, we should then drop to the ideal target zone of around 33,000 to 300, somewhere around there for this wave 5, bearing any extensions of the 5th wave. But you can see how the Dow Jones is really adhering very nicely to these Fibonacci extensions. I mean, we got the slightest of overshoot. That's fine. So we might get the slightest of undershoot for 4. That's fine. That's all fine. I don't care about those tiniest of margins. If you fall over, people thinking, you got this wrong because it should have bottomed there, then you can literally go after yourself. Anyway, they just don't understand. They don't see the forest through the trees. Let's put it like that. It's Friday, so let's babble a little bit more than just numbers. Semiconductors still looks good here for this B wave and another C wave. That remains the primary expectation. We know the levels. I've shared them with you ad nauseum, so I'm not going to repeat it. We know the levels to watch below where things are really starting to look dicey for this C wave, ultimately about 2250 for the semiconductors. Again, the NASDAQ 100, I'm looking for a 4 and a 5. We know in an impulse after 4 comes 5. Why do we know this is an impulse? Well, this is most likely a flat. 3 down, ABC for red A, ABC up for red B, and then we must see 5 waves down. That's the flat, 335. So that's our primary expectation. If we don't see 5 waves up, then something else is going on and we move further. That's how we go. And that was then the IWM here. Look at the IWM, picture perfect. I like this one, bottomed here right for nicely. Wave 3 should now be in wave 4, back to about, that looks about 176, 178-ish. Probably retesting the 50, and then it should drop off for this wave 5. ideally to 170, 172. So far, so good. Bottom where it had to. We should see a multi-day bounce and then a multi-day decline. And then the Santa Claus rally can start. Remember, the Santa Claus rally is the last 5 trading days of the year, I believe, and then the next few trading days into January. That's the Santa Claus rally. So we've got to stick with it. This also means that the average seasonal pattern for these indexes is generally alive. We're looking for a low on average based on 100 plus years of data. We're looking on average for a low this time of year. It's all plus or minus a week, sometimes even 2 weeks, but it's the general path that matters. We're in a low and then we should rally. So that still supports also the notion of the B wave. So those are all the indexes. Let's have a look at market breadth, new lows. Are limited at 133. It's going to get updated by the end of the day. Doesn't look too scary low yet, considering how much of a decline we've seen. How we're doing in McClellan oscillator. McClellan oscillator measures the amount of declining and advancing stocks. And if we have more declining stocks, it becomes negative. And if we have more advancing stocks, it's positive. It's currently at minus 82, so it's already starting to drop in the buy zone. Okay, this is getting quite low from where we might expect decent tradable lows. But I don't see reversal nor positive divergence, so we'll have to wait and see. Then we had a sell signal for the summation index, which adds every McClellan oscillator's reading for today to that of yesterday, which was added to that the day before yesterday, etc. And it is on a sell since Wednesday. So since Wednesday, it's on a sell. It was on a buy here since late October. So if you use this for buying and selling decisions, you still had some decent gains out of this. Not too bad, right? Doesn't work all the time, but nothing in the market works all the time. Everything works some of the time. Why? Even with Elliott Wave, when you have had 3 waves lower, you think the correction has completed. Nah, it can turn it into a flat. Then you get 3 waves back up and 5 waves down. So you get 2 more legs to go. Or you had a zigzag, it adds another zigzag and another flat, whatever it wants to do. So things don't always move in clear paths. Last but not least, the buy all, sell all. No update for today yet, but it is firmly, since yesterday, back in the bottoming zone. So expect this one to bottom out, and then we should eventually get a nice buy signal again, as long as we stay, of course, above our cutoff levels. So everything is on a sell. There's nothing that's pointing higher. The Elliott Wave count is pretty nicely on track. Most indexes are still following a pretty decent standard impulse pattern. We expect a end of year rally. The seasonal average of a low this time of year has to be shifted a little bit more forward in time. That's what it is. It's just an average. It's a guideline. It's not set in stone. And then please remember, I tweeted this, in a depression, everybody loses. The winner is the guy who loses the least. This is written or said by Richard Russell, a famous Wall Street investor or trader. And that is really true. It is also known as she or he who loses the least amount of money in a bear market comes out the winner. And in a bear market, the modus operandum is to destroy wealth. All the excesses that we've built up during the bull run need to be dealt with. So we stair step higher, right? 3 steps up, 2 steps down, 3 steps up, 2 steps down. So we need to reset the clock. Very few understand this, but if you do, you already have the right mindset to realize that profitable trading in a bear market is, in essence, swimming against the tide, because the tide is meant to destroy your wealth, not make wealth. So if you have that right expectation, then you can also manage the right outcome, that break even is still better than a loss. If your neighbor loses 80% and you lose 20%, you're still doing better because you have a lot more gunpowder left than your neighbor. That's the whole point. All right. So I'm not going to say here, so you'll be fine, you should lose your money. Absolutely not. We're trying to lose as little as possible, hopefully and preferably get some profits out of this. All right. So the current decline that we're seeing is profitable. Anybody who's not in inverse ETFs and all that stuff, using my work, I don't know what to tell you, but it is it is tradable. The last couple of days, really, really nicely tradable for sure. Seeing some members messaging me that have some really nice profits of my work. So fantastic. That said, in a bear market, Well, you know that the tide is against you from a profit point of view because the market only wants to take your profits away. You have to bring your A++ game, okay? Not an A game, an A+ game neither. You have to be A++. You have to be at the edge of your seat because the 2009 to 2019 area where anything went up is over, all right? That was the bull, we're in a bear. That is the market environment we're currently in. Just look at where price is in relationship to the moving averages. That's a bear market setup. Now, in the previous 2 decades, any scatter shot would hit target, or the last 10 years since 2009, all right? Now you have to be this lethal sniper. You have to take all resources you can get your hands on to make sure your trading is as good as possible. I'm trying my hardest as well. It's been a very, very tough year, but I think by the time we realized, when was it? May, June, that we were in a bear market and not anymore in a bull, work has definitely improved from my end in accuracy, if I may say so myself. There will always be misses along the way, but that's life. Nobody's perfect. Trading can't be perfect. There will be losses along the way, but have the right mindset. That is my take-home message. If you have the right expectations, then you will have also the right outcomes, right? You under-promise and you over-deliver. That's what you're doing. It's very important because this is a mental game, and when you see red days like today and yesterday, it is not easy to step in front of the train once the wave 5 bottoms, and hopefully it will bottom soon next week, so I can provide you those updates. Yeah, with that, I think we've covered all the indexes. I hope you appreciated this quick rundown of the indexes, compare what other people are seeing. We're all aligned, so I like it. And we also went over market breadth to see if there was any indication for a low in place. So far, none of all. So that matches the Elliott Wave as well. And we went over the market psychology in trading and investing and how to approach this current market and the market over the next few years. I hope you appreciate it. Have a great weekend. If you watch soccer, enjoy the match on Sunday. It's France versus Argentina, and or Argentina versus France, whoever you prefer. I'm going to watch it. It's going to be really cool. Take care, trade safe, and I'll see you all on Monday.